Today we're diving back into the fascinating world of the U.S. housing market. We've got a graph that tells an incredible story, from big crashes to even bigger comebacks. The big question awaits: will the housing market crash in late 2023? Stick around as we explore the ups and downs, hear from experts, and uncover the suspenseful truth. Is another housing market crash on the horizon? For nearly 4 years, prices across the country hit record highs. While investors and spectators were rewarded, shoppers were being hammered. Prices consistently increased as described in this S&P Shiller index chart. From January 2019 to June 2022, prices increased by 51% according to this S&P Shiller index chart. And in some cities like Seattle, it was even worse. This chart shows that during the same time period, prices increased by 70%. We'll come back to this in a minute. Before we continue, we ask that you please like, subscribe, and hit that bell icon as it would help us out a ton. This chart tracks the U.S. housing market using the year-over-year S&P Shiller National Price Index, offering insights dating back to 1990. It provides a comprehensive view of the market's trends, excluding the notable Wall Street crash of 1929. This crash led to a massive 67% drop in property values, triggering the Great Depression. But prior to it, real estate, especially in Manhattan, was thriving until recovery around 1960. Post-World War II brought stability, marred briefly by a 1974 dip due to inflation. The subsequent 2 decades saw prices soar due to relaxed lending rules, creating a real estate bubble. From the 1990s to the early 2000s, the chart suggests underlying issues: rising interest rates due to a savings and loan crisis, declining new home construction, and stagnant housing prices until late 1997. A subtle housing bubble formed, leading to a crash in the early 2000s. From 2003 to 2008, as seen in the graph, the market experienced a significant bubble with soaring home prices. However, this bubble burst in 2007, as shown, causing loan payments to surge by 60%. This led to a full-blown real estate crash in 2008, marked by surging foreclosures and economic turmoil. The repercussions lasted until 2010, with the housing market gradually recovering but leaving a lasting impact on home buyers and the economy. Over the past decade, the real estate market embarked on a journey of recovery. In the early 2010s, about 1.28% of all U.S. households were facing foreclosure. While foreclosure rates changed, the market generally stabilized. The value of single-family homes showed steady growth for 2012 to 2018, with the average property price reaching $261,600. However, there were signs that this journey had left its mark. Millennials at that time bought fewer homes compared to their peers before the 2008 crash. This decline in home ownership led to a rise in renting, with the number of renters in major metropolitan areas increasing from 36% to 41% between 2006 and 2014. Many renting households allocated a significant portion of their income to rent. These impacts stem from the 2008 crash, which also witnessed sluggish capital investment and income growth. Despite this, housing prices started to appreciate again, and by 2015, foreclosure notices had hit their lowest point in 9 years. Considering these lingering effects, it's no surprise that concerns about another housing crash, potentially triggered by events like the COVID-19 outbreak, loomed large, raising questions about how it would be managed if it were to occur. In recent years, the real estate market has seen exceptional growth, with housing prices surging by 51% from February 2019 to June 2022. Concerns about market stability arose, especially in cities like Seattle, where prices rose by over 70%, evoking memories of the early 2000s dot-com bubble. The market experienced substantial recovery from 2012 to April 2022, resembling the early 2000s exuberance, with annual growth peaking at 21.7%. However, in May 2022, the market faced its first significant drop, ending a 7-year streak of positive annual growth. In hindsight, as we look back at the unfolding events of 2022, it becomes clear that we were treading a path reminiscent of late 2005, following the well-established cycles of our economy. Back then, some optimistically believed things might be different this time, with hopes that inventory levels could shield us from significant price drops. However, as we fast forward to 2023, we can see how the once uncertain future has unfolded. The U.S. housing market has been on a roller coaster ride, to say the least, with unexpected twists and turns that have left both buyers and sellers on edge. In October 2022, the market was at its prime, experiencing a remarkable 38% surge in prices compared to its pandemic-induced slump in March 2020, as reported by Fortune. However, November 2022 brought a twist to the tale, with a 2.4% decline from the peak witnessed in June 2022, according to that Schiller National Home Price Index. This led to predictions of a possible drop in prices for the remainder of the year, raising concerns within the real estate community. Buyers and sellers were captivated by the looming possibility of a housing market shakeup. But then, in an unexpected turn of events, home values began to rise again. The Schiller Home Price Index reported consistent increases for 5 consecutive months, defying the odds and creating this sense of unpredictability in the market. Further emphasizing this unexpected resurgence, the National Association of Realtors revealed that more than half of U.S. metropolitan areas experienced gains in home prices during the second quarter of 2023. This challenged earlier predictions of a housing market crash and added excitement to this narrative. In July 2023, existing home prices hit a record high, with a median of $406,700, marking the fourth time it surpassed $400,000. NAR's chief economist, Lawrence Yun, declared the housing recession over. However, the situation wasn't without its complexities. Mortgage rates soared to levels not seen in over 2 decades, casting uncertainty on the market's future. Bidding wars made a comeback, and a shortage of available homes left potential buyers in a challenging spot. Experts voiced concerns that prices were unlikely to decline in this tight inventory landscape. Schuyler Olson from Zillow even predicted further price increases well into 2024, presenting a daunting challenge for first-time homebuyers. Federal Reserve Chairman Jerome Powell kept a vigilant eye on the situation. The housing market's sensitivity to interest rates added suspense to the narrative. While some feared a potential slowdown, most experts believed any correction would be more modest compared to the steep price drops of the Great Recession. The question that echoed in the minds of buyers and homeowners was, is the housing market going to crash? It's a question reminiscent of the period leading up to the 2007 to 2008 housing market crash, which had far-reaching consequences for the global economy. Key housing market statistics painted a complex picture. By August 23rd, the average mortgage interest rate for a 30-year loan had surged to 7.36%, a level not seen since December 2000. Home sales faced a 2.2% dip from June to July 2023, contributing to a 16.6% decline compared to the previous year. July 2023 witnessed a record-breaking median sale price nationwide, reaching a staggering $407,600. However, the housing inventory, measured by months' supply, lingered at a meager 3.3 months, far below the 5 to 6 months required for a healthy market. Foreclosure filings in July 2023 affected 31,877 U.S. homes, encompassing default notices, scheduled auctions, or bank repossessions, as reported by ATTOM Data Solutions. Maryland stood out with the highest foreclosure rate among states in July. While the prospect of price declines loomed, housing economists did not anticipate a repeat of the severe crashes of the Great Recession. The fundamental difference lay in the financial stability of today's homeowners. Those with mortgages boasted impeccable credit, substantial home equity, and fixed-rate mortgages secured at rates well below 5%. A June Redfin study revealed that an impressive 82.4% of all current homeowners enjoyed rates below that 5% threshold. Additionally, builders, bearing the scars of the Great Recession, approached construction prudently, resulting in a persistent shortage of homes for sale. Lawrence Yun underscored this shortage, saying, "We simply don't have enough inventory." Will some markets see a price decline? Yes. But with the supply not being there, the repeat of a 30% price decline is highly unlikely. The U.S. housing market has been a thrilling roller coaster ride, filled with twists and surprises. Will it crash in late 2023? Well, only time will tell. If you found this discussion insightful, don't forget to like, share, and subscribe for more updates on the U.S. housing market and other critical topics. Your support helps us continue bringing you valuable insights. Thank you for joining us, and we'll see you in the next video.